All right, today we're diving into one of the most fascinating and, let's be honest, controversial strategies in the entire financial world: short selling. Yep, it's that world where people can actually make a fortune when things go wrong for a company.
You know some of the most legendary trades in history? They were actually short trades. I mean, you've probably heard of this guy, Michael Burry. He's the one from the movie The Big Short. He famously bet against the subprime mortgage bubble and personally walked away with something like $100 million. Just incredible.
And then there's George Soros. I mean, this is one of the most epic short trades of all time. He bet against the entire British pound. It was a move that nearly broke the Bank of England, and it netted him a cool $1 billion. A billion from just one trade. So when you see numbers like that, you have to wonder, right? How on earth is it even possible to make money when a price goes down? I mean, we're all taught to buy low and sell high. Well, shorting, it just flips that whole script on its head. So let's pull back the curtain and figure out how this totally counterintuitive strategy actually works. Okay, so the whole concept really boils down to this one kind of weird idea. You start by selling something that you don't actually own yet. I know, it sounds like some kind of financial magic trick, but the way it works is actually surprisingly straightforward. So here's the absolute key. You borrow the shares, you don't own them. Then you immediately sell those borrowed shares, and you're just crossing your fingers that the price tanks. After it drops, you buy the shares back for cheap, give them back to the person you borrowed them from, and the profit, that's the difference between what you sold them for and what you bought them back for. So let's just break that down into simple steps. You borrow, you sell, you wait, you buy back, and you return. Simple, right? Now, I know that might sound complicated, but honestly, it's just as easy to do as a normal buy trade. Your brokerage handles all the tricky stuff in the background. For you, it's just clicking a button. Okay, to really get a feel for this, let's walk through the dream scenario, the perfect trade. And we'll use a company I think we can all get behind. Let's call it Donut Express. So, let's say you're looking for an opportunity. You notice everyone's suddenly on a health kick, and you think, this probably isn't great news for a donut company. You do a little digging, and it looks like their business is shaky. Costs are up, sales are down. You come to the conclusion that the stock is way overvalued, and you decide to make a bet against them. So, you execute the trade. You borrow and sell 500 shares at $10 each, and bam, $5,000 gets credited to your account right away. Fast forward a month, and your prediction was spot on. The company gets some bad news, and the stock just collapses, all the way down to $2 a share. Now's your chance. You buy back those same 500 shares for only $1,000, return them to your broker, and you get to pocket a clean $4,000 profit. That, my friends, is a perfect trade. But what we just saw, that was the dream. Shorting has a really, really dark side. It's a trap that has completely bankrupted countless traders. So let's stick with our friend Donut Express and see what happens when the trade goes horribly, horribly wrong. Okay, picture this. You're sitting there waiting for the stock to fall, and then out of nowhere, Warren Buffett goes on TV and announces he eats a box of Donut Express every single day for longevity. Can you imagine? The market goes absolutely nuts, and the stock doesn't just not fall, it skyrockets. And this is where the math starts to work against you, and it is absolutely devastating. See, you still have that initial $5,000 you got from the sale, but now to buy back the 500 shares you owe your broker, it's going to cost you $10,000 at the new $20 price. You're forced to buy them back, and you end up $5,000 in the hole. And this right here, this is the single biggest, most terrifying danger of short selling. Look, when you buy a stock, the most you can possibly lose is whatever you paid for it, right? The price can only go to zero. But when you short a stock, there is literally no limit to how high the price can go. A stock can go from $20 to $100 to $1,000, and your losses just keep getting bigger and bigger and bigger. Your risk is, in theory, unlimited. And as if unlimited risk wasn't enough, it's not even free to do this. You're borrowing shares, so you have to pay interest on them. And if a trade moves against you too much, your broker can hit you with something called a margin call. And that's basically them demanding you put more cash in your account, like right now. And if you can't, they will force close your position for you, locking in that massive loss whether you like it or not.
So with all these horrifying risks, you got to be asking, why would anyone do this? Well, the answer is because it unlocks a whole other side of the market that most investors just completely ignore. So let's dig into the strategy behind it.
Think about it. If you can only bet on prices going up, what do you do during a bear market when everything's going down? You just sit on the sidelines, right? Shorting lets you find opportunities no matter which way the market is trending. It also gives you this really powerful tool called hedging. It's kind of like buying insurance for your portfolio, a way to protect your other long-term investments if the whole market takes a nosedive.
And that really brings us to the ultimate question, doesn't it? On one hand, short selling gives you this incredible power to profit from failure, from downturns. It's a powerful tool in any kind of market. But on the other hand, it comes with that terrifying, very real risk of unlimited loss. So in the end, you have to ask yourself, is the risk really worth the reward?